And thank you so much, Winnie and Julie, for offering your time. We could not do this without you. And, Alexis, thanks for being on After Hours in Troy. And if there's anybody calling in for Troy, I appreciate you calling in a little bit late. So, real quick, the impetus for this event, as I mentioned, I'm president of the Southern California chapter. And beside events, I spent a lot of time coaching and mentoring both current students, recent grads. A lot of it's about networking, looking for their next position or jobs, that sort of thing. And through those conversations, I learned, and it struck me that the basics of how you think about planning your financials early in your career could be an interesting topic. And then I met Julie, and I knew Winnie before, but talked to Julie and Winnie at last year's new student send-off event, which is when we take the new freshmen going to RPI and we give them a warm welcome. So Winnie was there with her son, who's a junior, third year, right, Winnie? And Julie with her freshman. And I talked with them about this, given their backgrounds. They said, yeah, we think it's an important topic, and they graciously offered or agreed to put on this event. So that's really the driver for it. You'll find there's a ton of great information in the presentation. As Alexis mentioned, we are recording this, so don't feel like you need to memorize it. The idea is, what are some things you ought to be thinking about sooner rather than later as you embark on your professional careers. And certainly Winnie and Julie are available to chat with you, right? If you need to reach out to them, their contact info is here. Alexis will send that out after the event as well. Similarly, if you want a copy of the actual slides, you can contact Winnie and Julie for those. We do have some questions we got in advance when people registered, but as Alexis mentioned, send questions into the chat or raise your hand with the little icon at the bottom. We'll do our best to get to those questions. If not, Winnie and Julie might be able to entertain those afterwards. So that's all I had in the way of wind up. I'll now turn it over to Winnie and Julie to introduce themselves, their students, and run us through.
Go ahead, Winnie. I'll let you. So I just have a quick question. Can you guys see me or not?
Yes, we can see you.
Okay, because I'm not seeing myself, so it's throwing me off a little bit. So I'm looking at everybody and I don't see myself. So
we see you have the same wonderful office with the green trees in the background as Winnie does, which are out of place.
I wanted to share that I'm representing, RPI today in my sweatshirt. So
yes, very good, very good.
But yeah, I'll let Winnie go ahead and introduce herself, and then I'll take over because I'm doing the first part of the presentation. So.
Sure. So my name is Winnie Liu, and my son Gavin Liu is a third-year student at RPI. And he is definitely enjoying the school, and he's loving the school so much that he decided not to come home for March break. And I am a CPA, a CFA, and an investment advisor. So I help my clients to solve any money issues. And the more money you have, the more issues you have. But also, if you don't have money, you also have a lot of issues. But personal finance is not taught at school. But this is such an important topic. So I'm here to share some tips on how to build wealth. And if you have any questions, please let us know.
Great. And then, as Jim mentioned, I'm Julie Johnson. My son is Austin Schluter. He is a freshman at RPI. And he's dual majoring in computer engineering and electrical engineering. Very excited to be here. Just like Winnie mentioned and Jim mentioned, finance is not taught often in school. So we're definitely here to be a resource for you to help answer any questions and get you on the right path. My goal actually for my clients and the people that I work with is really to help you get the most life out of your wealth as opposed to the other way around. We want to make sure that your wealth is working for you in the right manner to help you accomplish your goals. I work for a firm called Beacon Point Advisors. I've been there for 15 years. And our mission as a firm is to provide comprehensive and objective investment advice and financial guidance that's focused on asset preservation and enhancement through sophisticated investment strategies. We're nationwide. We have over 60 offices across the country, and we oversee about $43 billion of assets under management. And we are the largest women-led firm in the country. So super excited about that. So obviously our topic is finance tips for early career success. some disclaimers that we'll have at the beginning and the end. But our agenda today is going over your goals and your financial pictures, your saving and retirement, investing basics, and then putting it all into practice. And then we'll do kind of a recap at the end. So to get started of understanding your financial foundations, a lot of it starts with your benefits that come from your employer workplace. And I know there's a lot of confusion when you first start a job, or even annually when you have a job during open enrollment, because open enrollment, once you start with a new job and you get your benefit package, it's sort of like, what now and where do I start? Fortunately or unfortunately, that happens every year during open enrollment, which is at the end of each year. But what are employee benefits? It's a benefit package provided by your employer, in addition to your salary, and it's designed to help you manage your health, your financial, and your retirement needs. And why is it important? It's important because it provides financial security, peace of mind, and long-term retirement planning for you. But from an employer standpoint, it's important because it helps attract and retain top talent. Because a lot of times, some people, if salaries are equal, some people will make their decisions on taking a job based on the benefits package. So what usually makes up your benefit package is health insurance, life insurance, disability, your 401k, and then stock options. So we could have a topic completely only on employer benefits, so I'll try to keep this short just to kind of touch a little bit on each one. So health insurance, typically you have three choices. You usually have an HMO, a PPO, and now recently they have what they call the HDHP plans, which are high deductible health plans. And it's really unique and individualized based on your health and your individual expenses. Typically, the high deductible health plans are just like they say, you have a much higher deductible. So if you don't go to the doctor very often, your premiums are lower, but your deductibles are higher. So the next least expensive one is the HMO plan, which does require referrals to be able to see certain doctors. So that is a little bit restrictive. So the cost is a little bit lower. And then the most expensive one is the PPO plan, which is has a little bit more freedom, and you can see any doctor essentially that you prefer. So there's no right or wrong. It's really just which one fits your individual needs. And then,
excuse me, real quick, just because that if there's some parents or guardians on the line, they may know this, but the students or early career folks may not. I mean, deductible. Describe what the deductible is, real quick. I don't think we can take for granted some of these terms we know well, others may know well also.
Yeah. And the deductible and it depends, because a deductible can work in multiple ways. The deductible is think of it as the hurdle that you have to overcome before your benefits kick in. Now, some insurances will say you've got some things that are essentially free, or where you don't have to meet your deductible, you would just have a copay. So, but many times think of the deductible as the hurdle that you have to overcome before the benefit kicks in to your advantage.
Right. So it's the amount you're paying out of pocket on your own before insurance covers.
Right.
Okay.
The amount you're paying out of your pocket before the insurance company will kick in. And then life insurance is something that a lot of employers will offer. And I do think it's important to choose the life insurance that the benefit package offers. Sometimes it's employer paid and there's no cost to you. And then sometimes you can buy additional benefits where you can pay for additional life insurance coverage. Usually there are two different types of life insurance, which it's usually term insurance and whole life insurance. The one that and your benefit package usually offers is whole life insurance. Term insurance is actually the least expensive because you're only insured for a period of time during the years that you need it the most, essentially. And then the whole life is, throughout your lifetime, it never ends. And you're sort of like, well, how do I choose which one? And actually, it probably makes sense at some point in your life to have a combination of both. but term insurance is usually the least expensive. And think of it as an income replacement. So depending on what the expenses that you have could dictate how much life insurance that you need. And typically a rule of thumb is anywhere between 10 to 12 times of your annual salary is how much life insurance that you should have. So we do encourage that, go buy the life insurance through your employer benefit, but it is important to often have a plan outside of your employer benefits because sometimes that is not transferable. So if you leave your company, you could be without life insurance. And sometimes if it is convertible, it's less expensive if you bought your own policy on the outside. So it's something to kind of consider. And then disability insurance is just like it sounds, is it provides an income replacement if you happen to become disabled. There's usually short-term disability and long-term disability. Short-term disability is usually between 3 to 6 months. Long-term disability would be anything over and beyond 6 months. It's relatively inexpensive to choose this benefit through your employer, and it can provide a very nice salary replacement, or it's actually a percentage of your salary if you happen to become disabled. And then I'm going to talk more about 401ks and Roth 401ks, but this is an important part that most employers offer a 401k. Not all employers offer a Roth 401k. And a 401k is a retirement savings plan that is offered by your employer, and it allows you to put money away that you can actually deduct off of your taxable income. And the key component to investing in a 401k is there's often a company match. So I come across people, especially in their early careers, that are not contributing to their 401k, whether maybe they just don't know about it or they just can't afford it, because remember, it is taking a portion away from the income that you're bringing home, but you are getting a tax deduction from it. But the advantage of investing in a 401k is you get a company match. The employer will match a certain percent of your salary and put it into your 401k for you. So basically it's free money provided from your employer into your retirement plan. And then we'll talk in the next slide about the advantages of a 401k versus a Roth 401k. Not all companies offer a Roth 401k. More and more are now, but it's relatively newer over the past few years. And then another benefit sometimes offered is stock options. And there's a couple of different types of stock options, the ISOs and NSOs. ISOs stand for incentive stock options, and NSOs stand for non-qualified stock options. And I'm not going to go into detail with the stock options because, again, this could even be a topic in its own. But basically, the difference between the two has to do with a combination of vesting schedules, the time that you can actually take possession of them. And then the biggest thing is there's differences in tax treatments based on the period of time that you hold them. So I wanted to go more into detail on Roth 401ks and regular Roth IRAs versus the traditional IRA 401k versus the Roth IRA and the Roth 401k. And the biggest advantage to both of these is the traditional IRA or traditional 401k. So those are two separate. An IRA is something that you can invest in outside of your company benefits. What the company offers is a 401k. If you don't have a 401k, or as long as you have earned income, you can invest in a what they call a traditional IRA. So the other options, like we mentioned, are the Roth 401k or the Roth IRA. And the biggest advantage of and differences between the two, there's two main big differences. The traditional 401k or the traditional IRA, as I mentioned, is tax deductible. You get to deduct that contribution from your taxable income. And then when you are ready to take it, you can see here at the bottom, all distributions are taxable as ordinary income when distributed. So you put money into it now, you get the tax deduction. It's tax deferred, so you're not paying taxes on it year over year. But then when you're 75 years old and you're ready to take money out of it, and it's grown astronomically, right, over the next 30 years, all of that income that comes out of it is taxable to you at whatever your ordinary income tax bracket is at that time. So flip to the Roth. The Roth, when you contribute to a Roth IRA, you do not get the tax deduction going in. Okay, so you don't get there's no tax advantage to it to going in. But the biggest benefit is it is tax-free coming out. So that 30 years that you could have, been contributing to your Roth 401k or Roth IRA and all of that growth going on inside, when you're ready to take it out, when you're 75 years old or once you're retired, you do not pay taxes on any of the gain at that time. So there's definitely advantages and disadvantages to both. If you're in a higher income tax bracket, you might want the deduction. If you're not, you might want to look at the Roth. The advantage of doing a Roth when you're in a lower income years is there is a maximum income limit. Once you exceed a certain income limit, you are not allowed to invest into a Roth IRA at that time because essentially you make too much money. So it does make sense to potentially do a combination of both. If you're in an employer-sponsored plan and they offer both a 401k and a Roth 401k, maybe you split. There's a certain amount every year, that number changes, that you can contribute to your 401k. And so maybe you split it and do half in one and half in the other. And we'll talk a little bit more about those numbers here. So I want to talk about sort of the hierarchy or the pyramid of a successful retirement plan. And the first thing that you want to do, this actually should say bad debt. Before you contribute anything in this triangle, we would like to see that you pay off any bad debt. So if you have, and really bad debt is credit card debt. Of course, if you have a car loan that has a reasonable interest rate, and of course a mortgage, those are more good debt versus bad debt because based essentially on the interest rate, because on your credit card, your interest rate is going to be much, much higher than any interest rate that you're paying on a car loan or even your mortgage. So we want to pay off bad debt. And then you want to have an emergency fund in place as well. And the next couple of slides, I'm going to get into your emergency fund. But once you have these in place, then we want to make sure that you do contribute to your employer-sponsored plan, your 401k or your Roth 401k. If you're a teacher or a police officer, they're called 457 plans or 403b plans. But start here and contribute enough to get the employer match. So you don't have to max it out. You can see here the 2025 maximum contribution for a 401k is $23,500. It tends to go up about $500 every year. I think 2024 it was actually $23,000. If you're over 50, there's a catch-up contribution, and this is actually new as of this year. There's a catch-up, sort of a double catch-up. If you're age 60 to 63, you can actually even contribute more than these two numbers combined. So you can actually add up all three of these. So you don't have to contribute the full $23,500 to get your employer match. There's a percentage based on how much your employer will contribute, and you can work with your HR department to determine how much that is. So we would definitely want you to contribute there first. Remember, it's a deduction from your paycheck. So one of the issues that you face is you are receiving less money on your paycheck. So you might want to start small, contribute what you can to get the match, and then see if you're able to match your living expenses. If you have money left over and you're able to save on a monthly basis, then if your company doesn't have a Roth 401k and you contributed to maybe a traditional 401k, the next place that we would suggest that you contribute would then be a Roth IRA to be able to get those tax-free distributions later in life. Okay, so this kind of just is start with your employer plans, then go to a Roth. Then if you still have extra money, go to that full 23,500 if you're under 50 and fully fund your employer 401k. And then a traditional IRA, and then non-retirement accounts. So once you've fully funded anything that you can get a tax deduction on, that's when then you would start to fund what we would call your non-retirement accounts. So I wanted to come back to what I said here, the emergency fund. So we do recommend that you have about 3 to 6 months of your living expenses set aside in cash. Just in case something happens to you and you are out of work, maybe that disability policy, remember that's 3 to 6 months that it will pay. But if something should happen and you're unable to have an income, we would hope that within 3 to 6 months that you would be able to find another job or the disability would kick in or whatever it is. But it just would give you peace of mind to be able to continue to pay your expenses and not go into any type of foreclosure, whether it's on your car or not being able to pay your rent or your mortgage. Try to have 3 to 6 months of living expenses set aside in cash. And when I say cash, get it out of your checking account. Don't just keep it in cash sitting in your checking account. Consider using some type of either online bank. It doesn't necessarily have to be a brick and mortar where you actually go to a bank, or if you go to a bank and you have it in your checking account, you usually have to put it in some type of brokerage account in order to get a money market rate or some type of treasury. It can't just sit in your checking account. You do have to move it to some type of brokerage account, but you can do it electronically where you can link them to your checking account. And look at the interest rates now. I mean, the interest rates are incredible. So you definitely don't want to have it sitting in your checking account earning zero. You can look at, these are updated rates too. And all of these are online banking that you can actually just set up a super easy transfer from your checking account to one of these online banks. And then when you need to replenish it, you actually just pull the money back into your checking account when you need it. But don't delay on getting any type of 4% interest rate in this environment. So let's talk about how to establish good money habits. Because I often get questions from clients that say, how much rent can I afford? If I'm looking at buying a house, how much mortgage payment can I afford? And so you want to, we take a look at what we call the 50-30-20 rule. And the 50-30-20 rule, what you do is you take into consideration your gross income before taxes. Then you have federal income tax, state income tax, FICA tax, state disability tax, all of these taxes that actually affect your net income. So for example, if you made $100,000, and this is an example that in California, your federal income tax, your state income tax, your FICA tax, and your disability tax ends up netting you out only $70,000 from your $100,000 of your gross income. So your net income is now $70,000. So now you would want to take 50% of this $70,000 or $35,000 as your absolute. So we classify these as needs, wants, and savings. So 50% of this number should be spent on needs, and your needs are housing, food, utilities. So this is a good way to kind of back in and say, can I afford that apartment? The $3,000 a month or $2,000 a month. You can kind of gauge and say, okay, is it more than 50% of my net income? And then you take 30% of your after tax. So 30% of this 70,000 or 21,000. And that's more your wants. And wants are going to be different from everybody's perspective. Cable, dining out, gym memberships. Gym membership for me might be under a need versus a want, because it's something that I need, that I feel like I just need to do, and it helps me, longevity essentially, and stress. But you then would say, make sure that you're not spending more than 30% on your wants. So maybe you forego dining out if you've already sort of maximized whatever this number is. And of course, these are annualized numbers. And then the last is savings. So try to take 20% of this number, or $14,000, and save it. The good news is the portion of this does count into your 401k, so your employer benefit, or a Roth IRA if you happen to be contributing to that. But you definitely want to make sure that you're at least putting 20% of your net after-tax income away for savings. So let's talk about building credit and why credit is important. And as you can see here, it may be considered for employment opportunities, but it's important to maintain a good credit score to be able to reduce your interest rate for many, many things that you apply for. You can get better loan terms, even for a car loan. They're going to run your credit score, and they might dictate what your car loan would be based on your credit score. Easier approvals for when you're applying maybe for a mortgage. If you have a higher credit score, it can get you a better interest rate as well. Even employment opportunities. Some employers, especially in the financial services industry, some employers will run credit checks and check your credit as well. So it's important to maintain a good credit, a good credit score. Insurance premiums, and then it really just gives you peace of mind and financial freedom to be able to have a good credit score and maintain good credit to help you with future purchases, investments, and any financial moves that you might make going forward. And then, as I mentioned, interest rates are a function of risk. So the higher perceived risk of late or missed payments, the higher the rate will be. So you can take a look at our example here of just purchasing a new car. You spend $35,000 on a car and a 5-year loan. If you could just get a 1% difference in interest rate, now it doesn't seem that much on a monthly payment standpoint, but you look at just that 1% interest has saved you over $1,000. So instead of a $35,000 car, you're actually spending $41,000 or $42,000 on a car based on the interest rate. So, and then using a credit card to create credit is a good source of developing credit, except that you do want to make sure that you pay your credit card off every month. Don't carry a balance, because as I said in the beginning, the credit card debt is the bad debt, and it's 24% interest rates. And if you're only making, credit card companies are smart. They tell you this is the minimum payment that you need to make. Well, it's going to take many, many years, and that compounding of that 24% interest rate, that one purchase that you bought then compounds over time and becomes, significantly more expensive. So when you use a credit card properly and pay it off, it does build your credit, and it can also provide points for travel or other purchases. So keep that in mind. Airfare, airline travel, Amazon purchases. So there's definitely some benefits to that. How do you establish good credit? As I mentioned, making timely payments and paying your bills on time will really help your credit score. We're going to look at the differences between the percentages of what makes up your credit score on the next slide. But you definitely want to pay bills on time, keep your credit utilization low. And what that means is you have a certain amount of credit available to you. Don't use it 100% of it. The sweet spot is 30% of whatever the available credit to you is what you potentially would want to have as debt. Only 30%, not 50% of what is available to you. It's also important to diversify the type of credit cards that you have, or the type of, credit that you have, not credit cards. You should have some in a credit card. You should maybe potentially have a car loan. If you don't have a lot of credit history and you are looking at buying a car, but you saved enough cash, you might want to look at just taking a car loan as long as the interest rate is low, and make 1 or 2 payments. And as long as they don't have a prepayment penalty, go ahead and then just pay off that loan, because it does help build your credit for later when you might be looking to buy a house. It does increase your credit score to have some type of credit on hand that is then paid off. So let's see, there was something else. We'll get to it, but I definitely want you to monitor your credit score on an annual basis as well. And then avoid opening too many credit sources at one time. You do want to spread it out over a period of time. But here's how not paying off your credit card can really put you, make that trip to Cancun or whatever it is, so much more expensive than it originally was. So you might have $3,000, 24% interest rate. If you're only making the minimum payment, it's going to take you 8 years to pay that off, and you would have paid a total in interest of $3,811. So your trip to Cancun cost you $6,800, not $3,000. So it kind of puts things into perspective. So here's the breakdown of how your credit score is calculated. 35% of it is paying your bills on time, your payment history. And then that amount of debt that I said, 30% of it is based on the amount of debt that you actually have. These are still important. They're just smaller. So over 65% of how your credit score is calculated is by paying your bills on time. And then definitely request an annual free credit report at annualcreditreport.com. And then for those that are married or considering getting married, I often see this: maintain credit in your own name. I'm also a CDFA, which is a certified divorce financial analyst. And when I'm working with clients going through a divorce, it's very common that maybe the husband bought the car and put it in his name. Maybe they're both on the mortgage, but the wife never purchased a car in her name or never even opened credit cards in her name. And so she doesn't have a very good credit score because she never opened credit in her name. So it's important for you as each individual people to have your own credit and your own credit score. Here's just another example of if you had a graduate student, a personal loan of $25,000 with an interest rate of 7.5. If you're just making the minimum payment, it would take you 20 years to pay off this $25,000 loan, and you would have paid $24,000 in interest. If you just make a higher payment, whatever you can afford, in this situation, they're paying $850 versus $200. It is significantly more, but it only took 2.7 years, and the interest paid was only $2,700. So it can be pretty significant when you look at the numbers. So now we get to talk about growing your wealth, the more fun stuff about ways that you can actually grow your wealth. Now that we've sort of done the do's and the don'ts of saving and spending, I'm going to turn it over to Winnie now to really talk about growing your wealth.
Real quick, excuse me, Julie, Winnie, just a reminder, we know we're going fast, there's a lot of ground here. But if you do have questions, send them in the chat. We'll keep them afterwards as well. And as I said at the beginning, if you have follow-up questions on any of this, again, the intent was give you an overview. Winnie and Julie would be available to chat with you separately. Okay. Thanks,
Great.
Winnie.
Great, thank you. So now that Julie has gone over some technical part of basic financial planning, I want to go over something that is also very important aside from the technical knowledge that you need for financial planning, and it is mindset. So first of all, you would need to be willing to learn, and the fact that you are here on this call, it shows that you're willing to learn. And secondly, you need to be also willing to change and to take action. So if I ask those two questions separately, most people would say, oh yeah, I'm very much willing to learn and I'm willing to change. But then if you are 70% sure on each question, then you take 70% times 70%, you're at 49%, which make your success rate below 50%. So I met a lot of clients or people who wanted to build their wealth for future, but after some time, some of them do not take actions, and as a result, a few years later, they are still back at where they started, i.e., going nowhere. So what I want to emphasize is that having the right mindset is very important, and so you should have a dream, you should have a mission or a vision, and this will drive you to succeed. And I know some of the younger alumni, younger folks will think that money is greed or you don't need it. But at the end of the day, even if you don't need it, you want to do good for charity, then you still need funding. And that's why there's so many charitable events to raise funds. And you also cannot build a bridge with your bare hands. You need funding. So just think of something that you would like to help, and that could be, what drive you to be your motivation. So understanding your net worth and balance sheet is the key points. Knowing where to start. First of all, assets are like cash, properties, stock, bonds, and gold, cars, whatever. These are things that you own. And liabilities are things that you owe, such as your student loans, your mortgages, your car loans, and other credit card debt. And your net worth is asset minus liability, and this is also called your balance sheet. So when you ask a lender or ask a bank to lend you a mortgage, for instance, they will want to know your balance sheet, and they will ask you to fill out a financial statement of yourself. And so this is very important to know where you are. Next slide. Yep. And then understanding the movement of money is also very important. When we talk about cash flow, it is your money moving in and out of you or an entity. So the net cash flow is the total cash inflow minus the total cash outflow. So knowing your current cash flow is important. So your gross income will be like your salary, your bonuses, your passive income, anything like that. And minus taxes that you pay equals net income. And then your net income minus all your expenses like your rent, mortgages, and your daily living expenses equals cash flow. And positive cash flow is what you're able to save, and negative cash flow is what you're not able to save, and you're actually dipping into your savings, which is not sustainable. And a lot of people get into trouble because of that. Now, and then a new interpretation of asset and liability that I want you to consider is having net positive cash flow in is what is called assets. And if you are generating net negative cash flow, then it will be a liability. So with that in mind, then I have a question for you. Then would you consider your primary residence an asset or a liability? And would you consider your car an asset or liability? Just think about the cash flow. So how to build long-term wealth? Number one, you of course need to generate more income, more than your W-2, and you want to minimize your expenses and therefore creating more positive cash flow. And then so you can save more, and then you can invest with that positive cash flow. And by leveraging using other people's money, OPM, think about mortgages and grants. So grants is the government's money, you don't need to pay it back. And mortgages, a lot of the times if you have a rental property, your tenants are paying for your mortgages in essence. And so you're using other people's money to fund your purchasing. And you should think about your spending, on an item, whether that item is has a potential of appreciation versus depreciation. For example, if you buy a car, the moment you drive off the parking lot, you lost a percentage of the value of the car. That's called depreciation. And then, but alternatively, if you buy a property and collect rent and raise rent, and eventually it's going to appreciate. So, rental property or investment property is probably have a higher chance of appreciation than a car. So now, if you have the same 50,000 to spend, which item are you going to spend on? Next slide. And also learn about delayed gratification, right? A lot of you, after some tough student life, and you might want to reward yourself by buying a BMW when you get your first job. But then consider, do you really need the Mercedes or the BMW, or a regular car will be fine? And not only consider whether you can afford that car at that time, but also think about the potential savings that you can save, because every dollar saved now is worth a lot more than the dollar saved in the future. And in this example, for example, if you are saving 25,000, by the car price difference, and earning a 7% return in 40 years is equals to 374,000 in 40 years. So you're not just saving this $25,000 now, but it is an opportunity cost of 374,000 in 40 years. And this is what is called the power of compounding. And Albert Einstein said, compound interest is the eighth wonders of the world. He who understands it earns it. He who doesn't pays it. And I totally agree with it. So this chart shows you, savings over time, how much it can do for you. If you start saving 1,000 monthly, starting at age 21, and just using a 5% growth, which is actually below, the S&P 500 historical growth, it actually will grow to 7 million at age 90. But then if you are saving starting 10 years later, doing the same thing at age 31, it will grow to 4.2 million. And if you start another 10 years later at 41, it will grow up to 2.5 million. You can see the big difference. When you start early, you actually can earn a lot more.
And Winnie, just a quick comment on it. So if we have on the line students and recent grads that are in their 20s, they're thinking, gosh, 90, that's way out there. The other point of this slide is look at the ages in between, right? And the amount that wealth grows in each of those scenarios. So you don't necessarily need to look at just the age 90 row at the bottom, but you can look earlier and see how that wealth grows in those interim years.
Right. And I also want to emphasize that a lot of people are living a lot longer now. So we actually have, I actually know a lot of people live above 90. So, and then this slide just shows you again the power of compounding. And by starting small, just cut a coffee from Starbucks a day, on average it's about $6 a cup of coffee. And if you just save that, in 20 years, you can save like 58,000, and in 40 years you're saving about close to 250,000, assuming a 6% annual rate of return, which is actually very achievable. And now most of you coming out of RPI would very soon earn 6 figures in your salary, and some of you may think that, oh, you're doing very well, and and you're very rich. But just so you know, the top 1% wage earners in the US earn about 800,000 annually. And the top 5% income threshold is about 350,000. And top 10% income bracket is about 148,000, which I believe most of you will be able to achieve soon after you graduate. However, becoming the top 10% earner seems to be pretty easy. You graduate from a good school, you are a professional, you get that number. However, going down to the next bracket, to want to be the top 1%, you almost always will need some kind of passive income to help that. Are you guys still seeing the slide?
No, I just lost the slides.
Okay.
I lost you guys too for a minute. So let me see. You're not seeing them still?
No.
I was going to see.
Right.
Let me see if we can get it back on. I might stop sharing and then we'll start again.
Yeah,
Are you,
otherwise,
Yep.
Julie, I can try sharing
yeah,
mine.
are you seeing it now?
It's loading.
Okay. I didn't know if it was I that froze or you that froze because you stopped. Yeah. It's not. It says that I'm sharing my screen. It's not there.
No, not yet.
Do one of you guys want to try?
Yeah. Or Jim, you want to share?
Yeah, let me do this real quick.
I'll stop sharing.
Okay, can you see my screen?
Still loading.
Yep, I can
Yeah.
see it now.
Yeah. So now let's keep going to active income versus passive income. Keep
Yeah,
going.
there's gonna be a little bit of a delay here. Let's do this. All right. What do you
Yep.
see there?
Yep. There you go.
Yes. So you just need to do full screen. Great. Thank you. Yep. Sorry about that. Now, so where I was. So I was talking about how to move from top 10% earners to top 1%. You will always need to have passive income. And so that's where I want your focus to be on is think about ways that you can generate passive income. So active income, income that you have to actively work for, your W-2, your 1099 jobs, and it takes up your time and you need to be present in order to make that income. And passive incomes are income that you can earn with minimal effort and or even without your presence, and even what I call it is what you can make it while you're sleeping. So examples would be rental income. Whether you work or not, your tenants are paying for your rent, and dividends and interest from stocks and bonds. Whether you're working or not, they are paying you. So those are good passive income. Next slide. And so in order to be the top 1% earners, you always need to start building your passive income. And you can build your long-term wealth by leveraging other people's money. The example that I gave before was some grants. You can use grants to build new businesses, like Elon Musk is an excellent example of that. And or using other people's money, like mortgages, to pay for your investment property. There are good loans versus bad loans. Sometimes I will meet clients who are very hesitant on taking up loans, but loans, there are good and bad loans. A good loan is what a liability you use to generate an asset, and then an asset is used to generate cash flow. That will be a good loan. And if you take this leverage plus velocity equals wealth generation. And velocity, what I mean is the number of times, number of turns you do it. So if you find a good way of leveraging other people's money, and then you repeat it again and again, and this is how you can build wealth over the long term. But I would advise you against taking a margin loans to buy stocks because those are highly volatile and you can lose everything overnight. So that is not what I encourage you to do, though. Yeah. Next slide. And what are investments? We have from the risk on the lower spectrum with bonds, and then to a high risk as alternative. So bonds are loans to a company or government entity, and bonds pay you semi-annual fixed income interest. And at the end of the day, after the term, you actually get your original principal back. and so those are bonds, and therefore the risk is lower. Then you have stocks. Stocks is an ownership share in a company, and the stock may or may not pay dividends, but there's a potential for growth, or it may also drop value. And this is what we also call equity. Now, alternatives, in general, the true alternative are things that are not bonds and not stocks. And these include real estate, commodities like gold, silver, like Bitcoin, like arts, and hedge funds. Hedge funds that are based on stock and bonds are not true alternative, but there are hedge funds based on other underlying securities, then that would be a good alternative. And why alternative are high risk is because in general they're illiquid and the time horizon is much longer. So your money is tied down in that investment longer. So that's why they are not advised for beginners.
And when again, just based on the audience, stocks includes things like mutual funds, which are groupings of stocks as well,
Correct.
not necessarily stock just in one company.
Correct. So it will include the ETF, mutual funds and like fund of funds and things like that. Yep. Next slide. So since you guys are engineers, you like charts. So I just want to show you a risk versus return scatter plot. And if you are analyzing which mutual funds or ETF to invest in, you can always plot it out and see if the additional unit of return is worth the additional unit of risk taken. And sometimes plotting them out, then you can see whether it makes sense to invest in one or the other. Next chart. Next slide. On asset allocations, so there are many ways to allocate your money into different investments. Most of the time, we want to focus on the asset allocation, like how much you allocate among stocks, bonds, alternatives, and cash. Timing is actually very hard to time. And if everyone can time the market, then no one will be working anymore because then everyone will be just speculating, right? And so overall, if you have a solid asset allocation for your need and risk, then you will do well over time. But security selection is also difficult, but some fund managers do have that skills, but marketing timing is just very difficult. Next slide.
And excuse me, Winnie, just a quick comment. I know we're at the top of the hour. We started a few minutes late, so we'll go maybe another 10 minutes. If people are able to hang on, great, but maybe we aim for wrapping up in the next 10 minutes or so if we can.
Okay, sure. So again, this chart is just showing you different returns from the categories, stocks, bonds versus cash. And then you can see over time, stocks usually outperform other categories. And then next slide. Jim is okay, right? And then how we decide on asset allocation depending on your time horizon, how soon you need the money, depending on your risk tolerance and appetite. And some people will follow the 60-40 modern portfolio theory, meaning 60% in stocks and 40% in bonds at all times. And this may be outdated because of recent market fluctuation. And some will follow like the rule of 100. That is, in general, you take 100 minus your age, and then that is the percentage that you will put in equities. But given how people now are living longer and longer, this might prove to be too conservative. Even if the investor is in the 60s. And so that means, like, let's say if you're 60 years old, then you put 60% in fixed income and 40% in equities. And then finally, it's diversification. Diversification will help you to even out some of the risk. And so never put everything in just one stock or one basket. Next slide. And this one is harder to read for you maybe, but this is a Callan periodic table of showing different subcategories of stocks, like large cap equities versus small cap equities versus high yield bonds and emerging market versus domestic market and cash. And you can see most of the time large cap are doing pretty well, and cash in general are not doing so well. And so this just give you an idea, based on your appetite and past return, what you want, how you want to allocate your portfolio.
And Winnie, just again for the audience, cap means what? If you could explain it, that'd be good.
Okay. Large capitalization, meaning that uh, meaning in general for public companies that have 10 billion plus, and capitalization meaning stocks price times the number of shares outstanding. So these are the mega companies like your Microsoft, your Apple, and whatnot. And then mid cap, smaller, medium sized companies, and then small cap, the ones that are smaller. And in general, large cap in general over time, tend to perform pretty well. But then there are markets that the small caps would perform better, maybe because of interest rate and certain stimulation by the government. Next slide. And then we want to allocate your savings with planning of different time horizon, right? The short term will be for immediate needs, for emergency, and the midterm, 3 to 10 years, maybe for your first home, for graduate school, or maybe for the next car, for wedding. And then the long term investing will be planning for retirement and maybe planning for your kids' college savings. Next slide. Yeah. And then also think about tax advantage investments, right? Some investments give you significant tax advantage, such as real estate. Real estate, why it is a good tax advantage product? Because it gives you depreciation, which is a paper loss. It's just an accounting calculation. You don't really lose in cash flow. And the IRS actually give you bonus depreciation in some years. And also you can do accelerated depreciation on certain items. And all these are paper laws that help you to reduce your tax burden, but not reducing your monetary cash flow. And then rental income, it provides you a passive income that you don't have to actively work for. And then you're using other people's money with mortgages, and it gives you appreciation potential. And then also after the asset appreciate, and when you sell it, you can use other internal revenue code to do 1031 exchange to defer your capital gain tax. And even if it's your primary home, you have some exemption on the tax on capital gain. So just overall, it's a very tax effective product. Next slide.
Just a quick comment there. So for the current students or recent grads, I think the point here is good thinking about tax implications of investments and things is really important as you start to earn income, invest, and so on, because it can have a big impact on how much you basically put in your wallet. I think that's the take-home point. I realized when you covered a lot, but that's probably the thing to think about.
Yes. And that's why it's also important to understand your bonuses at work, how it is taxed. I work with a lot of clients who have no clue, and until they are actually taxed, and they know they were shocked by the dollar amount. And so for the young alumni, I would say continue to stay connected, build your network, and build relationships with your colleagues and industry professionals, and also continue to learn, right? It's not only learning your professional knowledge, but also to learn about finance, personal finance, and other ways of generating passive income and investing. Next slide. Yeah. And then for call to action, after today's talk, I hope that you will have a better understanding of your own financials, find out what your balance sheet is like, and also, understanding your benefits from work, understanding your tax, and also start tax planning. And, understand your stock options, right? How they are taxed. Is it long term versus short term? Is it tax at capital gain tax rate, or is it ordinary income rate? And take action and educate yourself with different investment options and start investing and start early. And then once you figure out which way works best for you, then review it every year and then repeat itself. So that's a call to action list for you to consider after today's talk. I think this is the end of my talk. I think we try to put everything together in a short period of time, so we can answer any questions if there are some, or maybe Alexis, if there are some previously submitted questions that we can address.
Yeah, first of all, Julie, Winnie, thank you very much. And for everybody, again, we realized this was like, the proverbial drinking from a fire hose. The intent was to really tee up those things early in your career you should be thinking about, as well as maybe later. So I can't thank you enough for spending your time pulling this together and for all of you joining us. We could go to some of those questions that were submitted in advance. Let me, Alexis, can you pull those up? I want to be careful that actually, let me try this here. I don't want to, give me just a second. All right. Yeah, so there were a few questions. There was a question about the process to file taxes on earnings from internships. And I wonder, we've got the name, so maybe we take that one offline. There was also a question about alternative investments and break down the types and different class investments, stocks, bonds, and so on. I think we covered that, but again, we have the name, and I know the person's on the line. I know him. If there's a follow-up question there, great. How does the upcoming tax bill impact your work? I think that one again, my sense here, these are good questions and we know who sent them. And maybe what we do, Alexis, since we know the people who sent them, is encourage them. They could reach out directly to Winnie and Julie and take those on. That might be the best way to do it. They're good questions, but I don't think we have the time to adequately address them at this point, since we're about out of time. Okay, well, thanks very much. This might be the first of a series. So we've also talked about doing this. And again, Winnie and Julie have graciously volunteered to do something like this for people kind of, mid-career, later career. I think what we might do is maybe poll our region, engage interest in that, or we could take a leap and just put one together. But again, I think some of these things carry on regardless of where you are in your professional journey. Alexis, anything that I've missed here that we need to cover off on?
Someone did ask about the slides and making them available.
Yeah. If you just reach out directly to Winnie and Julie, and again, I think Alexis, you're gonna send an email around again with their contact information. You can reach out to them directly.
Absolutely.
Yes, we're happy to provide those slides for you, no problem.
Okay, and I see someone. I know Sarah would at least like a part two. So okay, we've got an audience of one at least, so we'll go for it. No, thank you again.
Good.
It's quite honestly, we took a little bit of a leap putting this on. Typically, our events are technical, that sort of thing, but this is important, and we thought we'd cover it. And again, can't thank Winnie and Julie enough. And bear in mind, they're available now to ask the million questions you likely have after today. So I can't thank them enough. And again, Alexis, thanks for staying on late to organize this.
Great. Thank you so
Very
much
good.
for the
Thank you, everybody. Take care.
Thank you.
Our pleasure. Thank you.
Yeah.
Bye.
Bye.